In this video, we're going to see how you, even as a beginner, can outperform 99% of investors in the next 6 to 12 months. The first thing is you must know what style of investing you're in and stick to it. It's okay to switch styles, but as long as you know exactly what you're doing. Are you a dollar cost averager? Do you do value investing? Are you a position trader who goes for very long-term trades, definitely uses technical analysis? Are you a swing trader? Are you a day trader or a dividend investor? These are different types of investing, but it becomes difficult to mix this into one account. Some are position traders or swing traders. But when a position goes against them and they have to sell for a loss, then they want to turn into value investors, saying that the company is undervalued, so they're going to keep holding onto their stock. Then when the stock goes still in their favor to make a profit, they do not sell because they do not have good selling rules. So you must know what style you're in, and then you have to stick to it. If you're enjoying this video and want to build financial freedom using the stock market, I put together a free guide called 10 chart patterns that make money. It's based on the exact system that we use at Profit Punch, a financial newsletter and educational hub that sends you A+ stock setups where we tell you exactly when to buy and sell, and also will teach you stock trading from the ground up. These are the same patterns that our members use to catch moves like SMCI 250%, NVDA 200%, Uplavin 350%. The guide is short, visual, and beginner friendly. Just click the link in the description or pinned comment to grab your free copy. Now back to the video. I have done a lot of research on dollar cost averaging. So you invest money at specific time periods. I found that for dollar cost averaging in the history of the S&P 500, you would have made about 8% per year. That is after inflation. These are true returns. So your money would actually be growing around 8% per year. For a lot of people, you already do this in your RSP or your 401k, so you don't have to worry about it. You can have your RSP as your second account, and then you can have another account where you actually do your personal investing. So in that way, you're saved by the historical averages of the market, but then you can also try to get aggressive. Value investors normally would like to wait 3 to 5 years, sometimes even 10 years. You must understand businesses, spend a lot of research into every company. You have to be patient, you have to be looking long-term, and you don't care about charts a lot. Position trading is you must have a little bit of technical analysis. The good thing about this is that it tells you when to get out. You don't have to trade that much. I think a lot of people can become successful as position traders because you're trying to get those very big moves. Because as a position trader, just one trade I have seen can give me 30% return on my account, just one trade. And the other trades can be mistakes, maybe eat that 30% down to 20%. A swing trader, on the other hand, you got to be quick on your feet. So you could be holding for 2 to 6 weeks, but you must be very good at risk management, getting out and getting in, because that's where your bread and butter comes in. Because the shorter the time frames, the less mistakes you can do. That's how investing works. If you're dealing on very short time frame, daily, minutes, the room for error is very little because you're doing things over and over again. You don't want to be compounding mistakes. Long-term traders, they can get away with some mistakes because they're not doing the thing over and over again. Day traders, of course, everybody knows what those are. For example, a long-term trader subscribed to the Profit Punch newsletter would have gotten an alert here to buy Google around there. That's after the 30-week and a 10-week crossover, and then they would have gotten an 83% gain. And then that's just one trade. It took like a year. They could buy here again in early 2023, then they would sell at the end of 2024. So you can see that they take very long to get out of their positions, and they're trying to get these big gains, but it does take some time. The good thing is that since they have a risk to reward ratio, they have a stop loss. That means that they also saved on the downside, so they know how far their account can go down. While a short-term trader, who is a swing trader, would have sold in 12 days because they have predefined buying and selling levels. This is something which we do for you in the Profit Punch newsletter. We tell you where to buy and sell, so you can sign up for that service if you like. Then there's an earnings gap up trade, and then you can see they would have been in for a while, sell after 14 weeks, could also have bought here again and then sell again. So they're getting gains, but they're doing it over and over again. Swing trading is a gray area. Some hold for a few days, others for a few weeks. It's not very defined like value investing. After understanding your style, we must understand the structure of the market. Now, this video is made in such a way that the things that are at the beginning of the video are the less important. This is how the market works. The market is a basket of all of the stocks. Now, those stocks, they're sectors. So it can be like technology sector, finance, healthcare, in those sectors. So for technology, you could have something like semiconductors. So those make semiconductor chips. You can have software application companies which make software applications. Then after those industries, then there are stocks. 80% of stocks follow their sector. So if semiconductors as a business is going down, you can see that in the stock chart, then don't buy NVIDIA because the odds are out of your favor. 80% of stocks follow the sector. A lot of stocks that are in the sector that do not follow the price structure of the sector are normally ADRs. So ADRs is a stock that is from another country, but there is a receipt on the USA stock market. Alibaba can have a ticker in the USA market and also in the China market. So the one in the USA market would be called an ADR. So Alibaba might be in the technology sector. If US technology stocks are going down, it doesn't necessarily mean that Alibaba might be going down because it is coming from the China market. That's why I said 80% of stocks follow the market. Sometimes the USA market is booming, but Alibaba is suffering. There are Argentina stocks which almost tripled last year, but USA stocks did not. Many Argentina stocks went up at least 150% during the year. So if you knew that I should look at Argentina stocks, then you would have profited. Then there are stocks which are based on commodities. So gold stocks, there's HMY stock, A stock, the uranium stocks, the stocks in technology, but hold things like Bitcoin, like MicroStrategy. This might not necessarily follow the technology sector because they are depending on something like Bitcoin. So to understand how that stock is going to act, then you have to be watching Bitcoin and watching the stock at the same time, because you always want to be watching the primary market and then you want to watch how the stock is going to be reacting within that market. So your job is to find the strongest sector and the strongest stocks in that sector. And there is a tool that can help you that I'll show you later in the video. For example, semiconductor stocks. The semiconductor ETF goes up 80%, but NVIDIA goes up 280%. AMD, which is also in the semiconductor business, goes up 140%. Qualcomm goes up 120%. The best stock in the strongest sector is because the best stock always moves way farther than all of the other stocks. And this is a good example. Semiconductors did 80%, but NVIDIA went up 280%. AMD went up only 140%. Qualcomm only did 120%. So it would always be better to be in NVIDIA. And something you can use is something called the IBDRS. So this is the relative strength. So you check the strongest stocks, and after finding the strongest stock, the one with the highest value, then look for the company which has the strongest fundamentals. And then that is likely your winning stock. Here we see gold stocks. So when gold is going up, the primary market is gold. That means gold mining stocks are going to go up as well. So you see, gold had this huge breakout in 2024 and gold has gone up 74%. But what has happened to gold miner stocks? Because they make more money from gold. AU went up 200%, as you can see. HMY went up 400%. AEM went up 182%. So you can see what I mean by find a strong sector, which is gold, then just buy the best stock in the gold sector. So here, if you put $10,000 in HMY, then right now you would have about $50,000. And then that could give you a return just because you're able to find that strong sector. Because every year there's always a theme sector. China stocks, same thing. After understanding market structure, then you want to master the market cycles and act accordingly because the market goes in cycles. So you always want to know which cycle are you in. There are times to make money. Then there are times when you just have to sit back at home and maybe read some books, revise your trades, revise your investment strategies because the market is not going to be doing anything. If you're in that tough environment, you're likely just going to be losing money. So it's better to sit out and wait. The market has bear markets and sideways action. So when the market is going sideways and has bear markets, you're most likely going to be whipsawed out. So it's always better to stay out of the market because 80% of stocks follow the market. So sometimes a stock has a very beautiful setup and it looks like it's going to go up in price, but since the environment for the stock is not good, that means that you have an 80% chance of failure. And if you have an 80% chance of failure, then that eats into your risk to reward levels. It's better to stay out as someone trying to long the market. Now in bear markets, if you know how to short, you can go short. That is something I do for you in the Profit Punch newsletter. When it's time to short, I remember when the market dropped earlier this year, I think some people made about 5 to 10% in their account because we managed to catch the short-term trades. Now you short if you know how to. And also when the market is in a bear market, you want to just be watching the strongest stocks because when the market falls 20%, but this stock has only fallen 5%, what does that tell you? That tells you that people are not willing to sell this. Even in a bad environment, no one is willing to let go. When the market goes back up, what do you think is going to happen? Of course, everybody's going to be in that stock and it's just going to run all of the edges. During bear markets, it's time to think, it's time to look forward. Watch the strongest stocks, short if you can, and refine your investing strategy. During bull markets, it's a time to make money. Choose a style. Do you like breakouts, buy the dip, or both? I personally do both. Find the best sectors and find the strongest stocks in those sectors. For example, NVDA did 200% last year, SMCI did 200% last year. If you put 10% of your account in those two stocks, you would have gotten your annual return easily. That 10% would turn into 30% to 20% return. SMCI would also give you a 20% return. So you'd have gotten 40% return from just two stocks, just finding two stocks, and then you can spend the rest of your year actually just making mistakes, because I found that only a few trades will actually make a huge difference. Then here we can see how a bear market can go. So when the primary market drops, it doesn't drop as much because it has so many stocks. You can find shorting opportunities in relative stocks because remember, 80% of stocks follow the market. It's the structure of the Hang Index, the Chinese stock market. It goes up and then it crashes 23%. But FTSE, which is an ADR, remember the ADRs we talked about earlier in the video? That one dropped 45%. So you had a better chance of making a profit shorting that one. GDS dropped 70%. XPEV dropped 40%. These stocks have a very strong beta. In whatever direction the market is moving, they move farther than the market. So I'm sure when the market was going up, these ones really exploded. When the market was crashing, they did crash as well. And after understanding that, the next is understanding the stock market stages. This is very important because you're starting to get into when to actually buy, and understanding the stage in which a stock is the most important thing for you to make money and for you to not lose money, because you're doing two things in the stock market. First, you're trying to make money. Second, you're trying not to lose money. And these are two different things. Just because you're making money doesn't mean that you're not losing money. Some people can make money, which is what I used to do earlier on, but then they easily lose money too. So at the end, they end up being losers. So what we want is make and don't lose. Two different things. Stocks have three stages. Stage one is when the 30-week moving average is normally flat. That's when you have to be watching. So stage two is when a breakout normally happens and then the 30-week moving average starts to slope up. This is the time to be in a stock. And then there is stage three when it goes sideways. And then stage four is when it crashes. So the best times to trade in a market, of course, get in at stage two. That's when you want to be trading. And then stage four, you're either out, you're shorting if you can. Stocks are always in one of these four stages: basing, advancing, topping, declining. Always use two time frames. Look at the weekly chart and the daily chart. So stage one, this is when everything is being accumulated. The stock moves sideways. The 30-week moving average is normally flat. Volume normally dries out, and you can see support and resistance. And a lot of people try to get in here, but it's very dangerous. It's better to wait for the stock to break out because, like I showed you, there's always a lot of room for the stocks to run. Then there's the advancing phase. This is where we all want to be. The 30-week moving average turns upward. This is the time to be buying, to make money. Here we see Meta drops from $350 to $50. Then it goes from $50 to $500. If you put in $10,000 into Meta stock, you got $100,000 in your bank account. You can just go buy a house. You see, the 30-week moving average goes flat and it jumps out. So at around $150 is the ideal time to get in. And then you would have ridden this till around $600. So that's about 6 times your money back. Still a lot of profit. And then the stop area, as you can see, 30-week flattens out. This is not a good time to be in. The reason why this is not the best time to be in is because lots of fake moves is going everywhere. And if you're not a skilled captain of your stock market portfolio, then these waves are really going to eat you out. So we can see stage one, stage two, stage three, stage four. It doesn't always happen like this. Sometimes it goes from stage one, stage two, stage three, then it goes into a stage two again. It doesn't always happen in this cycle, but at least these are the 4 cycles. Just don't buy in stage three. Wait for a very clear breakout. Then stage four, come on, guys. I'm not even going to say it. Be out. Don't touch it. Don't play games. This is the point where you can lose all your retirement accounts. Here we can see Sage. I think this is one of my favorite historic examples. It goes from around $12, $18. It runs all the way to almost $400. Then it goes from $400 back to $12, and it drops 96%. If you had 100,000, you're probably left with $4,000. That's how dangerous this can be. After that, master the major basing patterns. This is when we start to get very technical, and I want you to start paying attention. It's very crucial that you learn all of these patterns. They should be in your fingertips, and you should be able to tell them apart easily. A nice exercise that I like to do is for you to look out 30 examples of each of them. It takes some time, but once you do that, your mind will start being able to see them. And AI is not going to come and help us easily get these things easily, because AI needs a skilled person to train it, and I don't think a lot of people actually can pick out these patterns. You need to know the classical patterns: head and shoulders, double bottom, cup with a handle, flat base, box base, high tight, flag, ascending base, base and base, checkout, +3, virtual contraction pattern, and then 3C pattern. Don't worry about the names, just understand what is going out. And a lot of times is that people give these patterns special names, but they're all very similar actually. I just like to group them from the person I got them from. So Mark Minervini and William O'Neill, they pointed out these things. So head and shoulders bottom, very powerful. This normally happens in stage 1 while the stock is going to stage 2. You can see it's a head and shoulder, shoulder, head, right shoulder, then it breaks out. And this is a good time to buy. Here we can see a very good example. Uplavin went up 1,600%. That means your money would have multiplied 16 times. You put in $10,000, you get $160,000. That's how big this can do. So you buy there, see these major breakouts where you could have bought again, and return was huge. Then a double bottom base. This one is very easy to see, but what you like to look for is this undercut. So this undercut is when they try to push the stock down to chase out people who have been buying along this level, and then it rises up again. Here we see an example of a double bottom, checkouts, and then you see a breakout. It goes from a stage 3 to a stage 2, and then it moves up 150%. This is Novardisk. And then here it goes into a stage 3 again, and then to stage 4. You can see the head and shoulders pattern here, and then crashes. So you see this head and shoulders pattern is literally the opposite of this one. Yeah, of this one. So keep that in mind. Cup with a handle, this is always the bread and butter. The most important part is the handle. You want to see a cup, it has to be at least 4 weeks. Have that handle, wait for the breakout on volume. That's always nice. So there we can see our nice cup with a handle, breaks out on volume. Then VCB basis from Mark Minervini. What you're looking for is that the stock has these huge drops, but every consecutive drop gets smaller and smaller. You want to find a contraction which is less than 3 times of the average true range of the last 14 days. When you can find that type of contraction and it breaks out of that, that is normally a very, very strong move. Then there's a flat base, goes sideways, and then jumps out here, VITL, does 200%. Your money multiplies times 3, you put in $10,000, you get $30,000. These are signals I send you in the Profit Punch newsletter, so sign up for that. Very good service, money back guarantee. So it breaks out and you make your money just like that. High tight flag. This is more of a swing trade, not for long-term investors. So we see there it moves 100 to 120%. Even if I see 80%, I still go in. It moves sideways from the tight flag. We see both in the weekly chart and the daily chart, and then it jumps up, does another 115%. You can see earnings push that move. I actually found that a quarter of all moves in the stock market are normally fueled by earnings. That was quite interesting. This gap up should not scare you. There are still good buying times. Box base, it's almost like a double bottom. Names get confusing. As long as I see something that looks like a box and it jumps up in volume, good fundamentals. Here we see that kind of box base. This can be something called a zigzag, or it could even be called a flat. They're very similar. Sometimes they confuse me. And then we just see that breakout on volume. And then it goes all the way from around $400 to $800. That means it doubled. ASML. Very huge company. Very nice move. And then the next thing is to avoid rookie mistakes, because now your money is going to start going down the drain. A lot of mistakes come from you not using stop losses and adding to losing trades, and also holding losers and selling winners too early. Here I show you how much you've lost and how much you need to get back. So if you lose more money, you need to work harder to go back. But the reason you lost is because you lack skill. That means it's also mostly unlikely that you're not going to come back. Otherwise, you wouldn't be down that bad. Now, lastly, and most importantly, is you must master when to sell. If you don't know how to sell and lock in your big profits, you're basically wasting your time, and you should just click off this video, because without selling, how are you going to get your money? You have to take your money out of that stock market for you to enjoy it and call it a gain, and then put it back and make it work for you. I came up with very simple selling guidelines. I have the 20 exponential moving average rule. I have the 50 moving average selling rule, and then there are climax stops. Then there are others I do not use, but these are good to know. There's Stan Weinstein 30-week MA selling guides. There's a basing points stair-step method, which I read from a book called Stock Trends, which I don't use, but I thought it was good. I use these 3 rules: 20 EMA, 50 moving average, and then also you must master climax stops. So the 20 EMA selling rule is quite easy. When I have a 3% move under the 20 EMA, I sell 70% of my position because I realize that 80% of stocks don't recover. And if a stock closes under the 20 moving average, I do sell 70% of my position because I found that 80% of stocks don't recover when this happens. But if the stock returns and closes above the 20 EMA again, then I buy it back when it goes above the high of that candle, which closed above the 20 EMA. Of course, this is based on various conditions. Now, the other 30%, I can keep it from when it falls under the 50-day moving average. Or if the stock has been running up for a while, then I know that, hey, this is game over. Let's just get out. Because when stocks move, then they need to sit down for a while. Stocks move, then they sit down for several months, 6 months. Then they move again, then they sit down. But the moving time is very short compared to how long it sits down. Here we see NVDA's very big base. It sits down for 17 weeks. You see a buy point, which is a green candle, right? So if I see a checkout, that's a very good sign. Remember that. Coupled with a handle, we see that easy. We see that handle, like I said, you want a tight handle, which has at least less than 3 times the average range of the last 14 days. And then it breaks out on volume. So I color coded my bar, so if I get volume that's above 50%, the bar is green. Then the thing went up almost 200%. So here we see the first violation of the 20-day exponential moving average. Then here we see the violation of 50-day. Then you can buy back. Normally, the most trustworthy bases in a stock are base 1 and base 2. Base 1 is normally the big base that takes about 5 months, right? Then base 2 is the next shorter base that is normally less than 10 weeks that comes after base 1. But after these 2 bases, the other bases cannot be trusted. So these are the first 2 bases. So here, once NVIDIA came and sat here, I knew that it has to go and do work for its base 2 because that's normally how stocks normally act. And then here there's an earnings gap up, which is another swing trading strategy. So I would have added it back there, and then you could have finally sold there for a very huge gain. Then there's a 50-day moving average selling rule. This one is for those people who want to spend more time in the stock and don't want to be disturbed because the 20-day EMA needs you to put in a little bit more work. This one gives you more time to chill, but that means that you've given back a huge portion of your gain. So stocks that have respected the 10-day EMA for at least 7 weeks should be sold once they violate that line. They don't have this tendency, it's normally better to use a 50 EMA as a selling guide. This is a line I got from a book, and it defines here what a violation is. So it's a close below the 10-day moving average followed by a move the next day below the intra-low of the first day. The reason why this one is very important is that most fund managers use this, and a lot of stocks violate the 20 EMA easily. I just like the 20 EMA because it gets me out early and doesn't allow me to have those huge drawdowns. But the 50 EMA is normally actually best because it keeps you in the trade for a longer time, but you're likely to give back a lot of your gains. So here I show you some examples. So Kavana, we see the nice cup and handle sits down for 30 weeks. So you see whenever you see these big bases, you just know it's gonna run for a while. Breaks out, you just buy it here around $55. And at buy point, it was a bullish market because we have to need a bullish market, bullish environment, bullish industry. We already talked about it. A leading stock in a leading sector. We talked about this too. Super earning stock, and it's coming out of a big base. So just buy there, and then you would have just sat through all of this. So we see these minor violations, but there's a rule in that if it recovers in just a week, very few days, buy it back. So ideally here, you'd have always re-entered, but you can see that there are several violations of the 20-day. And the only time the 20-day worked best was this last run here, but most of the time, the 50-day was keeping you in this whole 300% move. The 20-day wasn't going to keep you through this 300% move. But by the time you sell, using the 50-day, you've given back about 30% of your gain. That's normally why I like the 20-day. Yeah. Then here, Palantir, we see this nice, big cup with a handle. Takes 22 weeks. Bullish market, bullish industry, leading stock, super earning stock, big base. Breaks out, you see that big green candle? Just buy that one. And then you just sit through the 50-day. You'd have sold there around $86. But you see, it went from 130 to 86. That's why I normally like and prefer to use a 20-day because instead of selling at 86, maybe I've sold at around 100. So sell $20 per share. So everybody pick your poison, but those are the major selling guides. And I hope you found value in this video. Sign up for the newsletter if that interests you. But also everything I've shared here is so that you can do this on your own as well. You don't have to follow any gurus or anything. I hope you found value in this video. All these slides will be on the resources page of the newsletter. May the markets be with you.